Trying to time the market is a difficult, if not impossible task. Our next guest says it's important to be risk adverse when it comes to investing right now. Joining us is Mike Morey. He's CIO at Integrity Viking Funds. So help us figure out what to do right now. I feel like Friday, we had the sell-off. People are thinking, all right, is this going to be the start of going back down? What are you telling clients to do right now?
Thanks for having me, Jen. When looking at the market and how it's performed so far year to date, it's had some really strong performance on a historical basis. And if we look at history, history tells us that we're going to continue to see strong performance throughout the year. However, our team at Integrity Viking do feel we're entering into the later cycle of the market cycle, which is time for companies or investors to become a little bit more risk adverse. So we feel it would be prudent to invest in companies that have much more stable business models, that pay dividends and have a long history of growing those dividends as well.
When you hear from clients right now, what kind of questions are they asking you? Because I think at the end of last year, it would have been obvious that, yeah, everyone's asking why the stock market's going down, but have people noticed the stock market has come back as much, or is there still kind of fear, at least, or a little bit of fear among your client base?
There certainly is a lot of fear. December brought that fear back in full force. And I don't think a lot of people were able to capture a lot of the upside we've seen so far this year because of that fear in trying to time the pullback, and a lot of money may have flowed out of the market in December. However, I think it's extremely important for an investor to stay exposed to equities, even if we're entering into a late cycle or into a recession, because it allows an opportunity to not try to time the market, but to dollar cost average your way in. And over the longer term, the market provides superior returns.
Another sign, I think, of the late cycle is the IPO flurry, right? And we are starting to see that. To my mind, at least, we got a lot of big consumer names, the Lyfts, the Ubers, Slack, Postmates. What about that? Are your customers asking about IPOs? Hey, can I get in? Or are they still a little gun shy because of what happened around Christmas time?
Right. So, with the government shutdown, I think it put off a lot of these IPOs, and that's why we're seeing the flurry here recently. We don't get a lot of questions on IPOs, and nor do we invest in IPOs. We're looking at companies that have been around for a long time and have extremely stable business models and strong free cash flow.
And let's talk about some of those companies and talk about being around for a long time. ExxonMobil traces their roots back to 1870 with Standard Oil. You also have AT&T and Coca-Cola in here. Why do you like these names?
Oh, well, looking at ExxonMobil, it has been able to, survive the recession and survive this most recent crash in crude oil prices and continue to pay a growing dividend. And its free cash flows are actually really strong right now, and we see those growing as we progress. It's made really solid capital expenditures, which, to be honest, investors have kind of frowned upon because they're asking for capital discipline. But these capital expenditures, I think, are going to allow the company to grow production immensely in the near future, looking at their projects in Guyana as well as their expansion into the Permian Basin.
Now, when you see the yield curve behaving as it does right now, leaving aside what it may or may not mean for the macro economy, if you're running a dividend fund, I mean, do you view this as a time when your opportunities are more attractive because you are getting 3 or 4% from a big, blue chip company instead of having to go chase the 10-year down at 2.5?
Yeah, absolutely. I think these dividend-paying stocks are extremely attractive versus treasuries. And looking at the inversion, the 3-month, 10-year inversion, I think it, kind of spooked the market to some extent. We're going to keep a close eye on the 2-year, 10-year and watch for a potential inversion there. But looking at the interest rate environment as a whole, we feel we're in a period where interest rates are going to stay low for a significant amount of time, and that makes this particular industry extremely attractive.
All right, Mike Morey, CIO of Integrity Viking Funds. Thank you so much for coming by and talking to us.
Thank you, Jen. It was a pleasure.